morning. Welcome to the Brew. I am Lex, your host. It's Taco Tuesday. We are going to continue our talk with Options 101. This is part 2. Maybe it's 102. I'm not sure. We'll let Molly decide. But let's get right to it on the Brew. Good morning.
Morning.
Look at you. Hold on. There's no white. There's no black. There's another color going on here today. Mal, what's going on?
This is really happening. I know.
What are we
I just
calling
went
this?
I did two more shirts beyond in my closet. I just was having the.
Are we having is there a wash day coming or something? Is that why we're into our cowgirl look?
Yes. Right.
Unbelievable. Looking good, Mal, as always.
Thanks.
I'm having another bad hair day, so I went with the ball cap, the Tradier Hub ball cap. So
you can't have a bad hair day, Lex.
Oh, you're right. I don't have enough hair to have a bad hair day. I get it. Good. So when we get rolling here, we're going to talk. I entitled this Options 101 Part 2, but I think we could call it Options 102 technically, right? I can't remember how college classes were numbered. I forget.
I think that's how Lex Ed. That's Lex simulation theory starts. So let's do 102. And I like that little bump up because when you're training or doing anything and you're studying, you like to know that you're making progress. So this is a really big thing you're going to talk about.
That's good. You know what I can do while we're talking? I can name it 102 because right now I'm looking at it, it's 101. So pretend like you're talking to me and I'm going to make it 102 right now.
Okay, let's go over the news.
Do some news. Don't tell me the market's down again, which I already know it is. My God, I'm so sick and tired of seeing.
I wanted to match the market today, so I dressed.
So you wore red?
Yes, that was the plan. Okay, Fed fund rate is really important for, we're talking to people who are just getting into trading today because this is a really good lesson. You can't go anywhere without this lesson Lex is going to give you today. So Fed fund rate is 5.5. We've got inflation at 3.5. So there's a lot of pressure and there's a need to get into trading. So we're going to keep an eye on that. Dollar's doing well. Yep. But here's the really juicy thing I want to look at. And we're going to have to do a lot of research on this. I'm going to give little pieces every day this week. Why is NVIDIA's CEO selling shares at the tune of 60,000 shares? What is going on? So either he's like adding a pool, buying a house. He could be a tax issue. It could be, he wants that lower tax rate. Could it be? Yeah. Could it? Does he have a hidden opinion about AI? There's a lot of talk.
Guys, those CEOs though, and again, I don't know the answer to this yet, but we'll have to dive deeper. When you have that kind of wealth, let's say, you liquidate some of these shares, and they do it through I can't remember the number, but it's an SEC number, and you do a systematic selling every month of a certain number of shares. Now that may be part of this thing. And the reason they do that, right, and the SEC wants insiders to do that is so there's no funny business about news that's coming out. So he does this month in and month out with the same amount of shares so that it's like, a cost of living or whatever you call it. But you can't just decide one day, oh, guess what? We're having a board meeting. The stock's going to go down. I better sell my stock. That's what they're trying to avoid. Right.
Martha
the number. I'll look it up. I forget what it is, but it's a 105, 151C something or other.
Yeah, and I
think that's a hard question, by the way.
Okay. We're on that. Max and Ruben, you're on that. So he's announced it, that his sell. So this isn't any surprise. And there's a lot, and I think his overall shares hasn't changed after the sell-off. These might have been options he's been liquidating.
That could be.
So yeah, we'll dig in, but it's a really interesting thing to see. So we are just still keeping an eye on. We've got a couple of Fed officials speaking this week, so they're gonna unveil their future, and they're anticipating keeping the rates higher for a little bit. It's been affecting the market. People are a little squeamish. So we'll keep an eye on
Do
that.
you get as sad as I do about red down markets? I mean,
Well,
not that I really cared in
I
the old days when I was trading, but now that, you're kind of invested in the market, so, you have investments, right? And investments are
yeah,
long. Let's call it what it is.
I'm
Every time I see red, I never look at that stuff, but red makes me sad.
I'm all
Except
about
when
the
you're wearing
protective put. I know.
the do-si-do outfit, of course. But
But I'm all about the protective put. So I tend to I'm really safe when I trade.
okay,
So I
well,
don't mind the
so am
red too
I.
much.
And when I
Yeah.
rock, I'm very safe. We're gonna see a little epi on that on
Okay, what's on
TikTok.
tap? What's on tap?
Well,
By the way,
today
what
we're
is your
gonna
TikTok?
yeah.
Sorry, I keep talking about it. What is your TikTok handle so everyone knows where to find you?
Well, here's the deal. They gave me a handle that I don't like, so I don't wanna
Okay.
say it. I want
Okay.
them to get a new handle that some of the ones we
All right.
talked about,
Okay.
and
I thought we were
then we'll
done. All
talk
right.
about it. What do you think?
All right. We'll have it for you tomorrow. How about that?
Maybe. I'm gonna push them. They're working on it. All right,
Okay.
so here's what we're gonna do today. We're gonna go. Yesterday we started options 101. Basic stuff, right? What's an option? What's a call? What's a put, etc. And we talked a little bit about spreads. Today we're gonna go into I affectionately options 102. I think.
I love
So
it.
I don't know when the 100s end and we start on the 200s. I can't remember from my college days, but we'll figure that out. I'm
Okay.
totally making it up too. So someone said to me the other day, actually, might have been yesterday. They saw that first episode. And they said, "Hey, it might be good instead of delving into deltas to talk about the difference between um, buying and selling options." And I'm like, "What do you mean? Everyone knows what the difference." And they said, "No, no, no. Some people think that buying a call, which is a long bullish sort of trade, is the same thing as selling a put, which is also a bullish trade, but they're not the same." Okay, so we're going to go through that today, I think, just to make it clear. And I never thought about this, but beginners, they have good questions, and this is a good one, I think. So we're
And
going to run.
bullish. And let's just make sure that everyone knows what bullish is. So that means you're hoping to grab the stock, that you're
Yeah,
really for it.
yeah,
Yeah.
and bullish just means that you expect upside movement in something. Okay,
Okay.
bullish is upside, bearish is downside. So if someone says, "Lex, are you bullish or bearish?" and if I said bearish, that means I think the market or the asset or the underlying is going to go lower. That's what that means. And in the
Okay.
options world, we can create all kinds of strategies that have a bearish bias, a bullish bias, a neutral bias, right? So there's everything in between. And we will dissect all those types of strategies along the way. And the point of that is too, Mal, is that hopefully folks who can glean some information from this, they can say, "Hey, I'm kind of a neutral kind of trader. I like that. What's a good strategy?" And they can find through the library of things we talk about something that fits their personality and how they like to trade, right?
Okay, and I'm a proponent to taking the floor hand signals to the bar, but also take this terminology to your date. So if you're on a date and some girl or guy says, "Did you have fun?" You go, "I'm bearish, I'm bearish, I'm bullish."
We might not have that date very long.
Okay,
Oh, that's funny. All right. Should we start?
let's go.
All right, let's go to the screen. Let's go to the slides. All right, now you're not gonna believe
Ooh,
this. It's blue.
I'm feeling patriotic. I
So
feel like we've
buying
worked
versus
this
selling
out
calls and
before.
puts. I said part two, but it's really options 102, whatever.
All right.
Watch this. I tried something. I tried to make some animation. Hold on. That's me.
Yes.
Did you see that? I had
Yeah,
that
that was
thing.
great.
It's unbelievable. So we're going to talk about buying versus selling calls and puts. I have a new
All right.
mechanism here on how to figure this stuff out. Okay. Oh my God, there's a lot of words here. Um. Okay. So buying or being long, just so we're clear, buying and being long are similar sort of behaviors. Okay. Whenever traders talk about long versus short, okay, long tends to go with buying things, short tends to go with selling things. But you can be short by buying a put, but we'll get in that second. So, first of all, buying a call. Okay. Again, this gives the holder. And when we say holder, the holder is the person who owns that call. Okay. That's what a holder means. So the purchaser of that call, okay, has the right, but not the obligation to exercise that option on or before its expiration date. Okay. And they exercise it at the strike price. So if you buy a 50 strike call, you are buying the right, but not the obligation to own that stock at 50. Okay. So, obvious question, what if the stock's trading 100? Well, you can buy it at 50, but don't forget that option premium has to be what we call parity. And that's the difference between the stock price and the strike price. So that option is going to be worth $50 if, the stock's trading 100. So where your profit lies there is you paid, let's say, $2 for that 50 call, right? It's trading way up at 100. Expiration comes, you let it exercise or, automatically. You're going to get stock at 50, but you have that premium of $50 in there, less what you paid for it. So your profit's going to be $48 in this example. And now you own the stock. Okay. Now you own the stock, right? Buying the put, okay, and we got to think sort of backwards a little bit. You're still a holder. You're still owning something. This is giving you the right, again, but I always say not the obligation because you don't have to exercise, to exercise this option before its expiration for the strike price again, okay? But when you exercise a put, you're getting short the stock. You're selling stock, okay, when you own the put, okay? So it's the opposite of a call. So it's a bearish strategy owning a put. You want to, you're hoping that the underlying goes lower because puts increase in value when the stock or underlying asset goes lower, okay? Anytime you're selling either one of these, you are forfeiting that right. You all of a sudden are giving that right away to the holder of the option. So when you give the right away, you are exposed to being assigned. An assignment means that when you're short something and someone exercises it, you're getting the underlying stock. Now, if you're short a call and you are assigned, what are you going to get? You're getting short stock, right? If you are short a put and you get assigned because you are short that put, you are getting long stock, right?
So
It's
review
the
that last
opposite of
part.
what the holder has. Go ahead.
So just short and long and review that just a little bit because that's some good stuff.
So I use those sort of interchangeably, buying in long, selling in short. So short just means you don't own. In this example, short means you don't own the actual derivative or the stock for that matter. So if I'm short stock, I've sold it. Okay, my open position is short those shares or selling those shares. If I'm long something, I own it. Okay, I've bought it and I own it. Now, like I said, buying a put, you own the put, but you're hoping it goes down because puts benefit on downside moves. Does that make sense?
Yeah.
Okay.
And that's the protective put. So I love those because that's like that's the insurance guy on the floor.
Yeah. So there's also something called a cash secured put, which I'm not going to get into, but you can sell a put and your hope is that you're collecting some premium. Hold on. Theta decay, theta harvesting. Thank you.
Wait, I thought he was coming for tea. So I spilled my tea this
harvesting
morning.
Theta. So yeah, there's a whole strategy around protective puts, and we'll talk about that as well. All right. Next slide. Oh, wait, I got one of these. I forgot these little guys come in like that. Look at that. Buying versus selling. I love this thing. All right. Here are the graphs.
This is great.
Here's a graph of a long call and a short call. Okay. So, someone said to me, hey, make sure you explain the difference between being long, calls and short calls and being long calls and short puts, for instance. And we're going to talk about all that. So on the left, I think if you can see my cursor here, this graph here is a long call. Okay, ready? So when we own the call, we own it at the strike price. So we buy a 50 call. In this case, it's a 40 call. It looks like on the graph here. So that's this number right here. So the 40 call. Okay. If you buy a call, you pay a premium for it. Okay. It's called the premium. You pay some value for it. Okay. And let's just say I'm making this up. It's $2. It looks like it's about $2 here. So the most you can lose on that long call is $2. And if you look at this graph, this arrow here is at the $2 mark and it goes down to zero. So if the stock goes for anywhere beneath 40 down to zero, you're going to lose that $2. You can lose that $2, right? At expiration, it's going to be worthless. You lose your $2, end of story. If you own the stock, right, at 40, you're long the stock, you can lose from 40 down to zero. Okay, so that's a lot different than buying this little insurance policy in a call and being stopped out at $2. Any questions on that?
And then, just that's where the GameStop issue happened. So with buying GameStop, there's a discussion about volatility in the market, and that increase. But really, if you're just buying the call, your losses are capped at that, just
They're
that
capped at that. That is
fundamentally. Yeah,
absolutely right. Yep.
you don't own the stock, and so the volatility might have been on the other side.
Right. Yeah. The only way you can gain access to ownership of that stock through this derivative, this call, is to exercise it. Okay, you can exercise things early in American exercise, or to hold that call through expiration, in which case, if the call is at least 1 penny in the money, that means the stock is 1 penny higher than your call strike, you will get automatically exercised and you will take delivery of that stock. Okay.
Okay, got
Now,
it.
I would tell you that in the pro world where I came from, that's common. You just let it expire. It is what it is. You've already figured this into your whole risk metric, and it just happens. In the retail world, I would say that most folks don't take delivery. Okay, for the most part, there are exceptions. They don't take delivery. What they typically do is they close these calls out and roll them. Okay, so they will sell that expiring option so that they don't take delivery, move it into a new term, different strike to affect a new strategy. Okay, so that's pretty typical in the retail world. They very seldomly, I think, want to take delivery. Sometimes they do, but mostly they don't. Okay.
And this could be a bad analogy, but let's say you're watching horse racing and you're standing in the bleachers and the horses are the actual stock. So you don't own the horse, but you can stand on the side. And we're not talking about gamification, no gamification.
You're not going to say the word betting, right?
Right. No betting. But let's say you have a ticket, for, give me a name, Lex. What's the name of a horse?
Oh my God. Well,
Lex Luthor.
Lex Luthor horse.
Yeah, so Lex Luthor's running and he's racing and he's doing better. So you can actually then trade that ticket and sell it because now it's a more valuable ticket because Lex is winning.
You could do that.
Talk about how someone might move. This is amazing. Look, Max is making me tea. Look at that.
Oh, you got
this harvested tea.
Okay.
And
you got
lots of love.
harvested tea. Yeah, the beauty of options though is you can apply it to just about anything, right? So that's an interesting, thought about the horse race. I didn't think about that, but you don't own the horse. You own a ticket on the horse's race. There's, whatever, half a mile to go or a quarter mile to go, and he's leading by a lot. Sure, your $2 ticket's going to be worth a lot more now. So you could sell it. You could sell it to the guy who's standing next to you. Who says, "Hey, I'll take that ticket. I paid $2 for it. If you win, you're going to win 100. I'll give you 75 for it." Well, you paid 2, and now you made 75, and you're taking your risk off the table.
Right.
Now, if the guy who paid 75, because it looks like a sure winner, horse all of a sudden stumbles over its feet, falls down, scrapes its face in the dirt, and doesn't win. Well, the guy paid 75. That horse, that ticket expires worthless if it doesn't win, right? And assuming you have a winning ticket. So, interesting analogy, Mal. I'll give you the little cowgirl bell for that. Very good.
Had to bring in the horse.
Absolutely. All right, let's look at a short call here. Okay, so it's the graph next to it. Now, you can kind of imagine this graph, this guy here, kind of flipping over, right? So now all of a sudden, when we're short a call, we're selling premium. Okay, that $2 all of a sudden is something we're selling. Okay, so we're collecting $2 when we sell that premium. Now, the only way to make the full value of that premium is if that underlying asset expires beneath the strike price for a call. Okay. And another key thing to take away is that when you sell things, credit spreads and selling calls and selling puts, your max profit is what you sold it for. Okay. So now it inverts itself. So the most you can make is what you sell it for. And the most you can lose is technically infinity. Okay. And look at this graph, right? If this stock keeps going up and up, you can see the profit keeps going lower and lower because the price of that call is going higher. Remember, you sold a $2 asset in a derivative called a call at 40, and the stock goes above 40. At 42, you break even, right? Because the difference between 40 and 42 is $2. That's what you sold it for. That's a break even. At 43, you're losing $1. At 44, you're losing $2, et cetera, et cetera. It keeps going up forever if that stock keeps going up. So you have unlimited risk on that short side, okay, with this call. Does that make sense?
Absolutely. These are great graphs, by the way. Just want to say that.
Don't think I made these. I probably violating all kinds of things by showing these. All right, let's go to the next one. Let's see where we are. I put these on the same graph, okay? Long puts versus short puts. Now, this is a bearish strategy, okay? Owning a put. Now, the long put graph is the dotted line. You can see where my mouse is, okay? So long puts benefit to the downside. So think about it. They have negative deltas. We'll talk about that on another episode. But as the stock goes lower, my put increases in value, okay? Again, it looks like this is about $1 from the graph a little bit. So this is $1 put. Looks like it's on the 100 strike right here. So you can see, or maybe a $10 put, I guess. So once we reach 90 to the downside, my puts break even, and then we keep making money all the way up, or all the way down, sorry, okay? And I can only lose what I pay for it. That's that $10 right there, okay? That's all I can lose. So it's kind of an opposite graph of what the long call looks like, right? Now, the short put. Again, remember what I said last time. When you sell something, you can make what you sell it for as a max profit. If I sold this for 10, okay, whatever this means, $10, 10 whatever, 10 shekels, that's the most I can make. And it's shown in this graph. If the stock keeps going higher and higher, remember, puts benefit from downside moves, but if the stock keeps going higher and higher and I sold this put, the most I can make is what I sold it for. And that's the representation of this part of the graph. However, if I sold this put, remember, puts get more valuable as they go down. And I'm short it. It's getting pricier and pricier. And I sold it for 10. It's going 11, 12, 13, all the way down. Boom, boom, boom. I'm losing my money. So you can see these graphs, how they behave next to each other, right? So I don't want people to get confused with, puts and calls. You have to kind of think opposite. Calls bullish, puts bearish. If you sell that opportunity, it's the opposite. But it's not infinity in terms of your profit when you sell these things, okay?
That's great. And then so that's like, okay, so if I'm in the middle and I say, hey, Joe, I think that's I'll pay you a small percentage now. I'll pay you like $20 to, it would always be like $2, and you promise that you'll sell that thing to me for a cheaper price in the future. And but then you go to Rob to your left and you say, okay, just in case the market crashes, I'm gonna buy a put just in case. So that you're gonna have to unload my obligation just in case I get into trouble. And that's owning the underlying stock in that situation. So if you own the underlying stock, so in that situation, okay, so if I own the stock, I'm going to sell a call, and then if I own the stock, I'm going to buy some insurance on it, so I'm going to buy a put. So can you explain how, if someone's first getting in and they own the stock, what would they cap that? What the cap would be?
Yeah, so now you're getting into the options 201 course.
Okay.
We're only on 102, but
Okay.
what you just described is like a collar, right? So
Yeah.
so you have an existing stock position. You're an investor. You believe in the stock. You have you own it, and then you're buying a put to protect the downside. You're selling a call upside to enhance some income. And typically, people who do that, they feel that they still want to own the stock, but they want to protect their investment. They probably have a good profit in it, putting that collar on to protect the downside, and then generate a little income to the upside. But don't forget, when you sell that call, you're forfeiting a good part of that upside, depending on where you sell the call.
Right.
When you buy that put to the downside, you're stopping yourself out from a big down move. And then it depends on where you put it. We'll talk about that in the collar episode. And when we do the collar episode, I'm going to wear a cool chain.
Okay, I love it. And if you're bullish on a stock and you're just buying a call and you're hoping to get that stock, so what kind of stock would you execute that on versus, let's say, a put?
What do you mean? I didn't understand that.
So these two examples that you had
Mhm.
in your last slide, what kind of stocks would you go after on those? Like what would be your stance on each one of those examples?
Again, these are all good questions, and I think they're a little more advanced than where we are now. But there's situations with long calls, and I've said this before. I try to find a way to sell options, okay, and I sell combinations of options, and I try to do it safely, okay. And what I mean by safely is I don't like to be short net units, meaning short more calls than I'm long or short more puts than I'm long, okay. So I really want to be careful of that, and we're going to stress that a lot. So it's like having a lifeline or a rope when you're climbing. You definitely want to be protected. Okay. But I like selling things more than I like buying them, because why do we sell things, or why do I like to sell things? Hello.
Little income.
You can
you like to
harvest theta.
harvest.
Oh my God. You can harvest theta. Every day can be a windfall. You just time keeps passing, right?
And now, Delta's a future show, but just give a little bit of the snack on harvesting theta. Just a quick snack.
I mean, when remember what I said about shorting things, right? So we've talked about options all the time, and options are wasting assets. They decay. As time goes on, they have to be either worthless or worth parity. And we've talked about that before, but we're going to do it again in another episode. And so that premium that you buy early on has to decay toward either parity or worthlessness or zero. So if you think about it, as time goes on, these options are decaying. If I own calls, I'm always long calls. I've got to fight time passing, right? Now, humans can fight time passing. You do a little exercise, you get a little Botox, all that kind of good stuff. You kind of fight it. Graph options, not so easy. You got to, when time passes, your options do what they're going to do. They're going to decay, right? And you need movement when you're long options to offset that. And if you don't get it, it's going to feel like a sucking sound. Just going to. And the worst sucking sound is when you're long too many options, you can't get out of them. So you're like, good Lord, I can't breathe. So anyway, I like to sell stuff. Okay. All right. I did this one. Okay. Now, someone said, well, Lex, a long call and a short put are both bullish strategies. Aren't they the same thing? They're really not. Okay. And we just talked about this, but let's see the graphs together. The long call graph looks like this. What do we notice? It's a hockey stick. I always refer to this as a hockey stick, right? That growth to the right is once the stock goes high enough to beyond the premium, in this case, $200, right? So 42-ish. Once it goes beyond that, we're Katie bar the door. It's dollar for dollar up there, right? So that graph, the long call, which is bullish, looks very different from the short put graph, which is also bullish. Now remember, being long something, you have infinite profit. Now I know people are going to say, well, you don't have infinite profit on a put because it can only go to zero. I get that. Okay, but let's pretend that's infinity. But to the upside on a long call, technically it's infinity. You don't have infinity on the short put. Even though it's long, you have a limited number, a limited amount. You can only make what you sold this put for. So these two graphs are very, very different. They are both profitable, okay, as you can see, to the upside. This profit is a catapult to the upside. This one is capped off at what you sold it for. Very different, right? Do we understand that, do you think?
Absolutely. I think that's a great explanation.
Okay.
You did a great job.
Let's look at, I love it. I'm doing it in the space bar. Google Sheets or whatever this is, Docs. I don't know, slides. Hit the space bar now. I learned this yesterday. Okay. So now, conversely, we're going to look at the long put versus the short call. Both bearish strategies. We want the stock to go down in both of these strategies. Again, same deal, except it's to the opposite way. Long put, you can see this. Once it gets beyond what I paid for this put, I start making money. Okay. And I make money infinitely down to zero. Again, stocks don't go below zero typically. Someone's gonna say, what about that USO? We'll talk about that in another episode. So yeah, you can you make money all the way down to zero with this long put. You don't make money down to zero with the short call. Okay, you only make what you sold it for. So whatever this value is, and let's just say it's $2, that's all you can make on the short call. So these two graphs are very, very different. Okay, they're both bearish, but one has infinite sort of upside and one has a limited upside, and as you can see, infinite downside. Okay, the long put has limited downside and maximum upside. Short call does not. So you're probably saying, well, okay, this makes sense. Why wouldn't you just, why would you ever sell anything? Because you have such risk. Well, that's a good point. But we're going to look at combinations, and we're going to start talking about butterflies and iron condors, where you can take advantage of being short stuff, okay, and cap these levels right here, okay. And if I go back a slide, cap this level here. So when you combine calls and puts, longs and shorts, okay, you can absolutely have a range where you make the money. Theta harvesting. Did I say theta harvesting? and you can cap your upside, or you cap your risk to the upside. So you curb that off. Okay. So we'll see how to do that when we
And
get to the spreads.
just for the brand new, trader, who I just wanted to say that just stay in here, because if you were to go to a foreign country, you will learn the language just by being saturated in it. So stay here.
Yep.
And even if you feel a little confused, it will start to clear up. And the more you saturate yourself, I mean, you can just go to sleep with Lex in your ear, and the unconscious mind will start to piece things together. But until then, Lex, can you just review one more time for everyone? What is long put? What is short call? Are you selling? Are you buying? And what's just final review on the 4 examples that you have on this slide and the next slide.
Yeah, this one here. So this is the long call versus the short put, right? So just as a review, long call, you own it. Whenever you own something in options, you have maximum profitability when you own it, and you're limited to what you pay for it. Okay. Conversely, when you're short something, in this case, we're short the put. When you sell something, your max profit is what you sell it for, and your max loss is unknown. It can technically be in infinity, right? Okay.
Right.
And long call and short put, both bullish strategies, but they're not exactly the same, as you can see from these graphs. Okay, and what I just said. Same with the call. I'm sorry, the puts. Long put, you own it. Max profit is technically infinity down to 0. Max loss is what you paid for this put. Okay. And then the short call, which is also bearish, you want the stock to go down, but you can only make what you sold that call for as a max profit, but you have unlimited exposure if you don't have any protection against that short call. And you can see that in this graph here. Okay.
Okay. So I was in a geometry class, and the class couldn't understand that a series of dots was a line. It just, well, no, it's a series of dots. It's not a line. So there was like, the teacher was about to just lose her mind, and I just raised her hand just to send her over there. Just like, I don't get it. So I'm going to just challenge you here. So break it down into real life. So I have my laptop open. Let's say I want to buy Apple.
Mm-hmm.
And, I don't want to get into the full stock. So a long put and a short call, what is the actual mechanism relating to an actual stock and its options surrounding that security? So give us even more simple. What does it look like? If you're going to explain it to a 9-year-old,
Mm-hmm.
and she's sitting, putting her first trade in, how would you explain even deeper without any jargon what to do there?
Well, I'm not sure what you're asking relative to that. Are you asking how do I make my first trade in Apple, or
So yes, you take a stock. So you can say long call and a short put, and it's bullish and it's bearish. But how take that even more simplify it even more, and say, okay, if I'm buying a call on, that means that I'm going to want to own that stock if it goes up, or if I'm buying a call. If I'm selling a call, then I'm going to unload my stock. So aside from all the jargon and all how do those 4 examples explain that on a very, I can touch on a tangible level?
Yeah. So here's what I'm going to do. I'm going to do that briefly, and because we're running late here. So here's the answer to the question. Okay. And we'll take this up next time, or a few times. This might be 202. There's so much that goes into to deciding what sort of options position you're going to put on a stock. Okay. And if you remember to my former days as a market maker, I always say this: we did not care what the underlying was. We could be trading options on handkerchiefs. We didn't care. I don't care the value of the handkerchief at all. I just need to know what the value of the options are in relationships. So that's not exactly true in the retail world. You have to have some sort of determination of the underlying. And when I say determination, it can be implied volatility, it can be direction, okay, or it can be both for that matter. So if you are looking to trade options on a stock, I would recommend that you do a little research on that stock. Okay, why are you getting into this stock? Are you bearish? Are you bullish? Are you neutral? What is the reason? When you tell me that, I think I can give you a pretty good option strategy to take advantage of your opinion. Now, someone might say, well, here's what I do. I look at charts. Great. I don't care if you go to a tarot card reader. If you have a good system of direction, you can absolutely use options to the nth degree to take advantage of it. And remember what I said, if I knew direction well, I'm most likely going to be using short premium strategies to take advantage of that direction. Okay. Unless, of course, and you always bring up GameStop. Look at, if I think we're going to have a binary move, and what I mean by that is it's a massive one, either up or down kind of move, massive. Okay. You might twist my arm to get me to buy options because those have unlimited payoff, right? When I buy them, right? Yeah. But I need to have that first piece of the puzzle solid before I can move to the second piece, which is options. And think about the first piece. That's the underlying asset. I have to know something about it, direction or not, right? Second piece is the derivative. Shocker, options are derivative. That's when you put the derivative on top of the first part of it, right? To affect what your belief is from that underlying. Capiche?
Perfect. Out of the ballpark.
Okay. But we'll get into a lot of that too, because we're gonna look at, ultimately we'll look at some graphs, we'll look at some of that stuff, and some charting things, and I'll show you how bad I am at it. It's really cool. I just make pretty colors with my charts.
All right. And just to clarify, what Lex was talking about, when you're talking about graphs, it's called technicals. And when you're really investigating whether a stock is good, it's called fundamentals. So stay tuned for tomorrow because we've got a little juice on NVIDIA that there's a dodgy 2B microchip purchase. So we're going to dive into why he's actually selling shares. And so the big reveal is tomorrow. Because it's hard. Good. It's a bit difficult to find, but we have it for you here.
Got it. And this is my pretty chart, by the way. That's the only reason I showed it.
I love it.
It's I changed my colors. I'm from New Orleans originally, so I decided to make a little LSU, even though they're out in Baton Rouge area. So yeah, that's about it for why I did this. Pretty cool.
I love these colors. My tennis bag were those color combo.
I love it. It's awesome. Yeah. Very cool. But we'll talk about all those bars as well as we get along. So anyhow, all right, we probably have to run, I think. So buying and selling options, don't get confused. The takeaway is don't get confused with bearish strategies where you're long a call versus short a put. They're both bearish, very different strategies. So that's a very key takeaway, right? All right, so we're on tomorrow. What's tomorrow? Wednesday?
It's Wednesday.
That, by the way, that's Prince Spaghetti Day, Wednesdays.
What is Prince? Explain.
I make an Italian dish on Wednesdays.
No way.
And we get into the Italian wine section of the
oh my gosh,
of the of the wine cellar. We're gonna do an episode from the wine cellar one of these days too.
You just have the coolest life, Lex.
I don't know about that. Anywho, all right, good to see you, Mal. I'll see you tomorrow.
All right, thanks, Lex.
Happy trading, and we'll talk tomorrow. Have a good one. That's a close.